What's up, traders? So, this video came as a question from my social media. I love answering questions because it inspires me to make videos to answer it for other people. If you're not already joined, make sure you click on the links below, do all the like, share, subscribe, make the algorithms happy, etc. So, the question is about logarithmic charts and do we use them as traders? And the short answer as a trader is no, I don't find them tactically useful for setting up trades in the moment. But they are used for long-term analysis of charts. Bitcoin is one of those. We'll come back to that. The other one is the Dow Jones, or excuse me, where is it? Let me find it. Dow Jones. There we go. We can look at, say, the stock market for the last 100 years. And if we look at a normal chart like so, it doesn't have very much meaning to us because we can't see really what's going on down there at the bottom. But if we use a logarithmic chart, now we begin to see some more patterns. We begin to see more structure. We can see that the 1929 crash, what it means in context for the market over the long run. We can also see periods of consolidations like from 1965 to 1981. So it helps really filter out something that looks like this, which is not very meaningful to us in the moment. Going back to Bitcoin, it's very useful in looking at Bitcoin over the entirety of its life. So if we look at this, we can see it had peaks and things like that. But if we use a logarithmic chart, now we can begin to see a little more structure inside this. But we can't really use indicators on it because you know how I love to use 50% levels, and well, it doesn't quite line up that way now, does it? So it's not really that useful for trading in the moment, but there is one key use of it that Bitcoin traders and investors look at, and that is the stock to flow ratio. What is that? Let's look at it. So it is a model that takes the supply, or rather the growth of the supply versus the existing supply, and creates a valuation. And so it's used in Bitcoin because Bitcoin has a limited supply. There will only ever be 21 million. And that production through mining decreases over time. Some of the classical ways of using it would be, say, in gold and silver, precious metals. In other words, there's only so much coming out of the ground in a year, and there's only so much out there. So you can track the growth of the supply versus the existing stock and create a model based on what the price is. It's basically a way of modeling supply and demand as time goes along. And of course, Bitcoin, because it has that limited supply and it has that fixed growth, you can apply this model to Bitcoin. That is the gist of it. So I'll leave this link for you to read more about the model itself. But here's how it applies to Bitcoin. And so if we look at a chart, this is a logarithmic chart of Bitcoin. And we're using that so that we can begin to see the meaningful patterns in the stock to flow model. How to read this chart is as such. If you look down here, the purple at the bottom, that's 0 days until the halvening event. And what the halvening event is where the miners, they're getting a certain amount of Bitcoin every block that happens at different times based on the mining power, and they get a reduced amount roughly every 2 years. In other words, what happens with Bitcoin, let's go back to that chart. With Bitcoin, this is what the amount of Bitcoins available based on the blocks, and it's not by time, it's done by blocks. This changes based on the mining power, and we'll only ever have 21 million. And slowly at each event, those rewards drop off. And that's what the yellow line is. And so the production, the amount that's being produced, halves every cycle. And that's why the supply goes up very slightly the longer that it goes on. And that's what the model is based on. And so over time, if you measure these events where the production, the growth decreases or halves, you can begin to see what price does in those situations or what it does right afterwards. So if we go back here to 2000, roughly 13, or right before 2013, right when the halvening happened, we're purple, we're 0 days to the halvening event. When the supply production got cut, Bitcoin shot up. That was the catalyst, if we look back in time, of the first real major big bull run where it got up to a little over 1,000. I know that was a big deal back then. And then as things normalize, and we're still waiting halfway in between the last halvening and the next time that production is cut, it does fall off and begins a consolidation period. Once again, right before the halvening event, or excuse me, right at it, when the production was decreased, it shoots up again. This was the 2017 big bubble run, and then it falls off again. And it just so happens that right before the event was the COVID crash last year in 2020. And then we had the halvening event. I believe it was in April, not looking at the exact date. And there goes our next run. So while people talk about inflation and dollar printing being a cause, just general risk appetite in the market, there is also a model based on supply and demand that people apply to explain this big bull run. So what does this suggest? Well, this suggests, again, we're using the logarithmic chart to see these meaningful patterns. We broke above what was the stock to flow average. And so if we extrapolate this right here, we can see that probably with time and price around the beginning of 2022, Bitcoin should top out. And that would be somewhere in here between 100,000 and 1 million. So right in here is about 200 to 300,000. That's what people that use the stock to flow model are projecting based on these last two cycles. Now, I don't discount this and I don't fully embrace it because there's been two instances where it worked. And if you had bought Bitcoin based on the stock to flow model last year, if that was your only fundamental reason for investing, you can look back and say, hey, I called it right. It could play out, but patterns, though they repeat, they are not 100%. So you still have to use your own judgment when you're looking at doing this investing. But this is a use of logarithmic charts, is for longer term analysis of instruments that have gone up exponentially. It helps you find patterns within them. But on a day trading or even swing trading or even within a month or something like that, they're not all that useful tactically. Hope this helps explain what they're used for and give you some ideas if you are a Bitcoin investor. Trade wisely. We'll see you in the next video.